Okay, let's think about this. What if the very foundation of the global economy, the US dollar, what if it's facing more pressure than we maybe realize?
Hmm.
You're tuning into the deep dive, and look, you're probably someone who wants to get your head around this complex global finance stuff, right? But without, getting bogged down in jargon.
You want the key insights efficiently.
Exactly. And that's precisely what we're aiming for today.
So today, we're digging into a really quite prescient report from Deutsche Bank. It came out back in November 2011 called, "Are We Entering a Post-Dollar World?"
Right, 2011. That feels like a different era almost, economically speaking.
It does. And the landscape has definitely shifted since then.
Yeah.
So our mission isn't just, looking back at what they predicted. It's more about using their historical view, their core arguments, to shed light on where we are now, the present world economic situation.
All right. So we're not just asking, is the dollar done for? It's more fundamental. What forces actually decide how long these big global currencies stick around? And this Deutsche Bank report, it takes us on quite a tour, doesn't it? Roman coins, Spanish silver.
British pound, Bretton Woods.
Uh,
Yeah, it really emphasizes that this whole international money system, it's always been changing.
And right at the heart of it all, as the report really stresses, is this concept called Triffin's dilemma.
Triffin's dilemma, absolutely crucial. And understanding that is key to making sense of today's debates.
Okay.
So, yeah, our aim is to really unpack Triffin's dilemma, trace how it's played out through history, just like the report did back in 2011. This should give you a pretty solid framework for thinking about the current discussions, about the whole international system and the dollar's role in it.
You mentioned things like SDRs earlier. Maybe just a quick refresher on what those are.
Oh, sure. SDRs, special drawing rights. Think of them as a kind of international reserve asset. They're created by the IMF, the International Monetary Fund, and countries can hold them alongside, say, gold or dollars in their official reserves. It's a potential supplement, or some argue an alternative.
Got it. Okay, so back in 2011, this whole post-dollar idea was a serious topic. What was driving that conversation then, and, how does it connect to today's world?
Well, the report points to a few big things happening around that time. First, the fallout from the 2008 Great Recession was definitely still being felt.
Yeah, that shook confidence.
It did. Confidence in the U.S. economy, its financial system. Then there was this growing sense that, relatively speaking, the U.S. was maybe losing some ground economically.
Emerging economies.
Exactly.
Yeah.
Particularly China. So you started seeing these efforts to internationalize China's currency, the yuan or CNY, and that naturally sparked talk about, well, what are the alternatives to the dollar?
And those anxieties about stability, about shifting economic power, they haven't gone away, have they?
No. If anything, you could argue they're even more relevant, maybe more pronounced today.
And it wasn't just talk, right? People were actually suggesting concrete alternatives.
Oh, absolutely.
Yeah.
The report mentions, for example, the governor of China's central bank, Zhu Xiaoshuan. He actually called for a new system, maybe based on a global reserve currency, something stable, rule-based, and importantly, not tied to any single country. And then there was a UN panel led by the economist Joseph Stiglitz. They suggested boosting the role of those IMF SDRs we just mentioned.
As a way to move away from relying so heavily on the dollar.
Precisely. Now, these ideas haven't fully taken hold, obviously, but they do keep popping up in conversations about reforming the whole system.
Okay, so the conditions were there, or seemed to be there, for a potential shift back then, and those pressures are still around. So the report then asks a really basic question. What makes a global currency, this monetary anchor, actually fail?
Right. The report talks about how global economic growth often relies on a monetary anchor. Usually it's a major economy, providing its currency stable, widely accepted for trade, investment, central bank reserves, all that.
And this creates a kind of symbiotic relationship, as the report calls it.
Exactly, symbiotic. The anchor country, the one providing the currency, usually gets a benefit.
Cheaper borrowing costs.
Yeah, basically cheap financing, because everyone wants their currency, keeping interest rates lower than they might otherwise be. And the rest of the world, they get the liquidity they need, the readily available cash, essentially, to do business globally and grow their economies.
Okay, makes sense. But this is where the problem comes in.
This is where the tension lies.
Yeah.
Triffin's dilemma. It's the potential flaw in this whole setup.
Okay, let's nail this down. Triffin's dilemma. What is it exactly?
Okay, so Robert Triffin, the economist, he was looking mainly at the Bretton Woods system after World War II. And he saw this fundamental conflict. If your currency is the world's main reserve currency,
Like the dollar became.
Like the dollar. To meet the world's growing demand for that currency, for reserves, for trade, as the global economy expands, you, the anchor country, you have to run persistent current account deficits.
Meaning you have to buy more from the world than you sell to them.
Yeah. Imports have to exceed exports. That difference flows out as your currency, supplying the world. Think of it like a central bank constantly having to print more money because everyone needs it.
Okay.
But, and here's the dilemma, running those deficits year after year means the anchor country piles up debt. Its liabilities to the rest of the world just keep growing.
Right.
And over time, that mountain of debt can start to, well, erode confidence. People start questioning if the anchor country can actually sustain it, if the currency is really stable in the long run.
So the very thing that makes it useful, supplying the world with currency, eventually threatens its own stability.
That's the paradox. Fulfilling the role undermines the role itself, potentially. It's a really tricky balancing act.
And the report's point is, this isn't just about the dollar or the post-war era. This goes way back. Let's talk Rome. How did they fit this pattern?
Well, the report looks at the trade between Rome and India. Even back then, India was a huge exporter to the Roman world.
So India had a trade surplus.
A big one. And Roman writers like Pliny the Elder actually complained about it. Huge amounts of Roman gold and silver were flowing east every year to pay for Indian spices, textiles, luxuries.
Ah, so a drain of their precious metal.
Exactly. A monetary squeeze, as the report puts it, inside the Roman Empire. A shortage of the very thing their money was based on.
So how did the emperors deal with this? This sounds like an early version of Triffin's dilemma.
It really does. Well, they tried a few things. Emperor Vespasian apparently tried to restrict imports of luxury goods from India. Didn't really work. The demand was too high.
Okay.
The more common approach was debasement of the coinage.
Debasement. You mean making the coins with less actual gold or silver?
Precisely. Gradually reducing the precious metal content, but keeping the coin's official face value. It's basically the ancient world's version of printing money, right?
Mm-hmm.
Stretching the metal further.
Which usually leads to inflation.
You got it. The report cites some pretty dramatic examples. Between, say, 138 AD and 301 AD, the price of a soldier's uniform apparently went up by something like 166 times. Wheat prices also shot up. Clear signs of inflation driven, at least partly by this debasement.
Wow. But here's the interesting thing. The report notes, even as the coins got worse and the empire eventually weakened, Roman coins were still used and even copied elsewhere for a long time.
It's remarkable, isn't it? It shows how sticky a dominant currency can be. Once it's established, trusted, has those network effects, it takes a lot to displace it, even when the foundations are eroding.
That inertia is powerful. Okay, next stop. Spanish pieces of 8. How does Spain's story fit the Triffin model?
Well, Spain hits the jackpot in the 16th century.
Right.
Massive amounts of silver flooding in from the Americas at Potosi, places like that. Between 1501 and 1600, just huge quantities of silver and gold arrived.
Making Spain incredibly wealthy and powerful.
Initially, yes. But Spain also got involved in endless, very expensive wars all over Europe. The 80 Years' War, conflicts with France, England. And this meant they were constantly spending, importing goods and services to support these wars. They ran persistent trade deficits.
And paid for them with?
With silver. Those famous pieces of 8 flowing out of Spain and across Europe.
So Spain was, in effect, pumping liquidity into the European economy through its military spending, like the anchor country in the dilemma.
Exactly like that. And the report argues this inflow of Spanish silver did boost liquidity, economic activity, maybe even helped fund parts of the Renaissance.
But the downside for Spain?
Well, same story.
Right.
Massive inflation within Spain. Prices are estimated to have quadrupled, maybe more, in the 16th century. And critically, Spain got buried under war debt. They couldn't service it. Led to multiple sovereign defaults, 1607, 1627, 1649, and ultimately Spain's power declined.
But again, just like the Roman coins, those Spanish silver dollars, the pieces of 8, they stuck around as a key global currency for ages, right? Even used in the U.S. officially until the mid-19th century.
Right up to 1857. Long after Spain was a dominant power. It just reinforces that point about resilience. Once a currency gets embedded in trade, it's incredibly hard to get rid of.
Okay, so Rome, Spain. The report then moves to Britain and the pound and the gold standard era. This seems a bit different.
It is, initially. The report talks about Britain's triangular trade system in the 19th century. This was quite clever, in a way.
How did that work?
Okay, simplified, it was like this. Britain sells manufactured goods to India, buys raw materials and opium from India, sells the opium to China.
Right. The infamous opium trade.
Infamous, yes.
Yeah.
Buys tea and porcelain from China with the opium money, then sells the tea and porcelain back in Europe. You see the triangle.
Yeah. So the money flows in a circle, more or less.
More or less. It allowed Britain to finance its imports, especially from India, without a huge, persistent drain of gold or silver for a while.
Yeah.
It sort of managed the balance of payments issue, temporarily sidestepping Triffin's problem.
But, as the report notes, this wasn't exactly a benign system. It relied on force, the East India Company's power. It wrecked Indian industry, led to the Opium Wars.
Absolutely. It was built on unequal power and had terrible consequences. It wasn't a sustainable or fair solution by any means. And eventually the world shifted. By the late 19th century, most major countries, including Britain and the U.S., adopted the gold standard.
Where currencies were directly convertible into gold at a fixed price.
Exactly. The Bank of England, the U.S. Treasury, they guaranteed you could swap your pounds or dollars for a set amount of gold. This linked the major currencies together and, in theory, provided stability.
And there was a bit of luck involved in making this work for a time.
Yeah, the report calls it a lucky coincidence. Huge gold discoveries happened around this time. California, Australia, South Africa.
Ah, so more gold was coming into the system.
Right. It increased the global gold supply, which helped provide the liquidity needed for the growing world economy under the gold standard rules, without necessarily forcing Britain, the main anchor at the time, into huge deficits.
But it wasn't perfectly smooth sailing even then.
No, definitely not. There were still periods of inflation, deflation, financial panics. The system wasn't immune to shocks. And then, of course, World War I completely blew it up.
Right. Trade disrupted, countries printing money for the war.
Exactly. Britain tried to go back on the gold standard in 1925, but it didn't really work. The conditions weren't right. They had to abandon it again in 1931 during the Great Depression, basically choosing to prioritize domestic liquidity over the fixed gold link.
Which really sets the stage for the U.S. dollar's rise. The report discusses the Bretton Woods system, set up after World War II. How did that try to fix things?
Well, Bretton Woods was ambitious. It pegged the U.S. dollar to gold at $35 an ounce, fixed rate. Then other major currencies were pegged to the dollar.
So, still linked to gold, but indirectly through the dollar.
Precisely. The dollar was the official anchor, backed by U.S. gold reserves. But almost immediately, Robert Triffin himself pointed out the flaw.
The same flaw.
The very same dilemma. He warned that for this system to provide enough dollars for global trade and growth, the U.S. had to run deficits. But doing so would eventually drain U.S. gold reserves and make it impossible to keep that $35 peg.
And that's what happened.
That is exactly what happened. Right after the war, Europe and Japan were rebuilding. They actually needed dollars. There was a dollar shortage. But by the early 1960s, the problem flipped. The U.S. started losing gold as dollars held abroad were cashed in.
Were there attempts to fix it?
Yeah, the report mentions the gold pool, basically. A group of central banks trying to cooperate to keep the gold price stable. It didn't work. The pressure was too great.
And this is when we hear about the exorbitant privilege.
Yes, the French finance minister, Valéry Giscard d'Estaing, coined that term. The idea that the U.S. got this special benefit from being able to just print the world's currency. But eventually the system broke. 1971, President Nixon unilaterally ended the dollar's convertibility to gold. Bretton Woods collapsed.
And the report mentions Germany and Japan reacted differently.
Kind of illustrates the choices countries face. West Germany, always worried about inflation, had tried to prop up the system. Japan, on the other hand, had benefited from the stability but was quite hesitant about letting the yen become a major international currency itself. They preferred the dollar link initially.
It seems like no one really wants the burden that comes with being the anchor currency issuer, even if there are privileges.
It's a huge responsibility, and it imposes constraints. That's a recurring theme. The report suggests the dollar regained credibility partly through the Fed's tough anti-inflation stance under Paul Volcker in the 80s.
Right, high interest rates.
Very high. And then, of course, the U.S. becoming the sole superpower after the Soviet Union collapsed in the early 90s. This all set the stage for what some analysts at Deutsche Bank later called Bretton Woods II.
Bretton Woods II, what's that?
It's the idea that a new informal system emerged. Asian economies, especially China, started pegging their currencies, often unofficially, to the dollar and focusing on export-led growth.
Selling goods to the U.S.
Primarily. And accumulating huge dollar reserves in the process. This, in turn, meant they were essentially lending money back to the U.S., keeping U.S. interest rates low, and financing U.S. consumption and deficits.
So similar dynamics to the original Bretton Woods, but with Asia, particularly China, playing the role of the surplus countries.
Exactly. And just like Japan earlier, China was pretty cautious about letting the CNY become a major global currency too quickly.
Further cementing the dollar's role.
Right. So even by 2011, after the huge shock of the financial crisis, the underlying structure, this dollar-centric system, was proving surprisingly sticky.
Which leads into the report's discussion on the economics of persistent imbalance. They saw the 2008 crisis as fundamentally a crisis of the system, right? Linked to debt, credibility loss, Triffin's dilemma playing out again.
Very much so. Governor Zhu specifically invoked Triffin's dilemma around that time, and it led to renewed calls for big reforms. Go back to gold, give the SDRs a bigger role, create a new world currency.
What did the 2011 report think of those ideas?
Pretty skeptical, frankly. It argued, based on history, that gold doesn't solve the underlying imbalance problem. You still need liquidity. And SDRs. They just hadn't gained traction historically. Lack of political buy-in, established networks weren't there.
And a single world currency.
The report touches on the tragedy of the commons idea. Managing a single currency is hard, especially without political and fiscal union. They pointed to the Eurozone's struggles back then as an example of those difficulties.
So the report's view was basically that Triffin's problem is maybe unavoidable if you want a single anchor currency.
Pretty much. They argued that aiming for constant equilibrium might be futile. The global economy often just works with imbalances. Participants kind of tolerate the distortions, the seigniorage or exorbitant privilege the anchor country gets, because the alternative, a fragmented or unstable system, might be worse.
Seigniorage, that's the profit a government makes just by issuing currency, right?
Exactly. And the anchor country gets a global version of that.
So the world is often willing to pay that price, so to speak, for the convenience of the dollar system.
Up to a point, yes. And the evidence in 2011 seemed to support that. The report highlights how, despite the crisis, the dollar's overall value, its trade-weighted index, was actually quite stable. And, crucially, the world kept lending to the U.S. at incredibly low interest rates.
Even though the U.S. was running big deficits.
Yes. They showed charts of U.S. Treasury yields falling. It suggested continued confidence, or at least a lack of appealing alternatives. The report also made the point that just running a surplus doesn't guarantee success. Look at the U.S. stagflation in the 70s, a time when it briefly had a trade surplus.
And finding another country willing and able to be the anchor, that's the hard part.
That seemed to be the biggest hurdle. Who else could run the necessary deficits, supply the global liquidity, and maintain enough credibility for their currency? Japan, as we saw, was historically reluctant. China was still hesitant about fully opening its capital account and letting the CNY float freely.
And the report mentions Ricardian equivalents. How does that fit in?
Yeah. That's a bit technical, but basically, it relates to central banks intervening in currency markets. When, say, the Bank of Japan buys dollars to stop the yen rising too fast, the report suggests that this intervention, viewed through a Ricardian lens, implicitly reinforces the dollar's anchor role. It shows everyone is still managing their currencies against the dollar.
Okay, so pulling it all together, what were the main takeaways from this 2011 perspective on the future?
The big conclusion was, history shows no system really solves Triffin's dilemma. Even a world currency wouldn't magically fix imbalances. The dilemma might only be managed, maybe, by a dominant power actively trying to balance things out like Britain's triangular trade, though flawed, or maybe something like the Plaza Accord in '85, which had mixed results.
But generally, the system persists with imbalances.
Yes, and despite all the criticism of Bretton Woods II, that China surpluses U.S. deficits, its basic structure had survived the financial crisis. The core message really was the incredible resilience of an established anchor currency.
It can outlast the country's peak power.
History suggests so. Look at the Spanish peso, the British pound. And potential successors, the U.S. itself back in the 30s, Japan, China, they often seem reluctant to actually take on the anchor role quickly.
So the prediction back then was even if China becomes the world's biggest economy?
The dollar was likely to stay dominant for a long time. Any shift would probably be very slow, very gradual.
Okay. So wrapping up the key insights from that 2011 viewpoint, Triffin's dilemma is this core tension: provide liquidity through deficits, but risk your own stability. History shows this pattern repeatedly, and despite crises and shifting economic weights, the established anchor, the dollar in this case, has this deep resilience, this inertia, making a rapid shift unlikely.
That's a great summary. And this report, even though it's over a decade old now, it gives us such a valuable lens, doesn't it? The history, the theory, It helps us understand these enduring forces. Triffin's dilemma, the stickiness of anchor currencies, these ideas are still incredibly relevant for making sense of the global economy today. The debates about trade, about currency roles, about the reserve system, they're all still happening within this framework.
Which really leaves us with a big question to think about, doesn't it? Given everything we've discussed, this historical resilience, this inertia, what kind of events, what combination of factors could actually trigger a real lasting shift away from the US dollar down the road? Something for you to chew on after this deep dive. Thanks for joining us.